not financial advice. I'm recording my thoughts about Pubmatic. Pubmatic stock is currently trading at about $17.4 with a market cap of about $900 million. In this video, we're going to discuss whether Pubmatic can double from this price to about $35 by 2027, thereby giving us a 2x. First, let's talk about Pubmatic's business model and how they're doing when compared to their competition. Then we'll move on to the financials and look at some numbers. And finally, we'll move on to the valuation. Pubmatic operates a sell-side platform for advertising using a specialized cloud infrastructure. As you can see on my screen, Pubmatic mediates between the publishers and app developers on one side, and on the other side, they also deal with the demand-side platforms like TTD and also the advertisers and agencies. Facilitate transactions between these stakeholders, and recently they facilitated about 516 billion daily ad impressions, and they had dealt with 1.4 trillion advertiser bids per day, and then 7.4 petabyte of new data processed daily. So this is a proven company with a real product. Let's now look at their competition. As you can see on my screen, there are multiple alternatives to Pubmatic. There is Google Ad Manager, Magnite, OpenX, AdSense, etc. But Pubmatic has been claiming that it has its own cloud infrastructure and it doesn't need to depend on the likes of AWS or Microsoft Azure to process the data. So they are saying that since they own the cloud infrastructure themselves, they will get some advantage with respect to operating expenses, and thereby they can grow faster than their competition and also have better gross margins. Bears of Pubmatic argue that this is not necessarily an advantage. If Pubmatic has its own cloud infrastructure, they have to have a matching utilization as well. When the utilization is less, then relying on the likes of AWS and Azure is a better option than having own cloud infrastructure. So let's look at how Pubmatic is doing with respect to its competition. And I picked Magnite, which is close to double the size of Pubmatic. When I look at the revenue growth, as you can see on my screen, the revenue growth for Magnite is in the double digits, and when you look in 2022, it's in the triple digits, right? Now let me show the revenue growth rate of Pubmatic, and when you look at the revenue growth rate of Pubmatic, you can see 8% in the most recent quarter, that's actually trailing 12-month basis, and I see low teens and 24%, 34%, while Magnite had significantly higher growth. So Magnite is actually bigger than Pubmatic, right? So Magnite should grow even slower because they're already big. But Pubmatic, even though they are small, not growing as fast as Magnite. But that tells us that Pubmatic doesn't have any great advantage when compared to Magnite when it comes to revenue growth. But when I looked into the gross margins, MGNI has 36 to 60% gross margins when I looked into the trailing 12 months for the last 8 quarters. But Pubmatic has gross margins in the order of 66% to 74%. So that's almost 20 to 30% higher gross margin for Pubmatic when compared to MGNI. So in conclusion, even though MGNI is growing faster than Pubmatic, Pubmatic has better gross margins. Let's now look at some financials. As you can see on my screen, the revenue for the past 12 months is about $257 million for Pubmatic. That's a price to sales of about 4, which is not too expensive. The PE ratio, however, is 56. That is definitely expensive for the growth that Pubmatic is achieving. Which revenue in the first quarter of 2023 was about 55.4 million, and that's an increase of 2%, just 2% during the same period in 2022. So that's definitely a concern. And they also posted GAAP net loss. They were actually making profit in the previous quarters thanks to their very high gross margin, but that did not work in their favor this time. And net dollar-based retention was about 105%. It's not terrible, but at the same time, it's not great. And total cash equivalents, and marketable securities are about 173 million, which is plenty, and they can survive for more than 1 or 2 years with that cash. And they also authorized the repurchase of about 1 million shares. They have close to 55 million outstanding shares, so 1 million shares is about 2%. So they authorized about 2% buyback in the recent quarter, which is not too significant, but it's definitely a positive. Now let's look at the guidance for this year. For the full year of 2023, as you can see on my screen, they did not give any revenue target. They're only giving adjusted EBITDA, which is not a good metric. I don't take that seriously. And they're saying the free cash flow will be on par with 2022. So the fact that they did not give any guidance shows that they do not have much confidence in what they can achieve. So I'm expecting that this whole year will not be good for pubmatic. Now let's move on to the valuation. I'm going to give two cases. One is a base case, and based on that I'm going to take my investment decision, and I'm going to show another case with great execution. So in the base case, the 2022 revenue is about $256 million, and the revenue growth rate in the recent quarter is 2%, and they're not confident enough to give a financial outlook for this year. So I'm assuming 10% growth rate year on year, because the ad market has to get better in the coming years, but I do not see a significant advantage that pubmatic has compared to its peers with respect to revenue growth. So I'm going to assume 10% year on year, with which they can make about $412 million of revenue in 2027. Pubmatic gross margins are in the order of 60 to 74%, right? So when the gross margin is in the order of 60%, I can assume a net profit margin of 20%, because that is achievable. So with 20% net profit margin, they can make about 82 million net income. And for a company that's growing in the 10% range and has a net profit margin of 20%, I can assign a multiple of 15. But since pubmatic is still a growth company, supposedly, I'm going to give it a slight premium, and I assign a multiple of 17.5, with which this company's market cap would be about $1.43 billion. This company's number of outstanding shares is in the order of 55 million, and that's pretty much stagnant. They're not diluting the shareholders, which is good news. Even when they give stock-based compensation, they're buying it back. So I'm going to keep the number of shares at 55 million only. And with that, the stock price in 2027 would be about $26. But wait, currently it's about $17.4, right? So that's about 50% gain in 5 years, which is not at all attractive. Let's move on to the great execution case. I'm assuming 12.5% revenue growth rate for the next 5 years. And I put the net profit margin as 22.5%, and I send a multiple of 20. Based on this, the stock price in 2027 would be about $38, and based on the current market price of about $17.4, that's about 117% gain, almost double, right? So if they do great execution, that's when pubmatic will double. In the base case, the gain is only 51%, which is not attractive when compared to the risk that I'm taking when I invest in pubmatic, who doesn't have any moat. So overall, I'm going to stay away from pubmatic. Let me know your thoughts in the comments. Thank you so much for watching.